Your account was working yesterday. The balance was visible. The payments were clearing. Nothing seemed unusual. Then this morning, a message appears. Your account has been temporarily restricted. No prior warning, no detailed explanation, no timeline. If the system is stable, why can access disappear overnight? If the money is yours, why is usage conditional? If compliance is routine, why does restriction feel sudden? Restriction without warning is not an accident. It is a feature. This is not about personal error or isolated fraud cases. It is about how modern financial systems are designed to preserve institutional stability through conditional access. The architecture of contemporary banking prioritizes liquidity control, regulatory compliance, and systemic risk containment above uninterrupted individual usage. When stress surfaces, the system does not collapse first. It restricts. To understand how restriction becomes possible without visible breakdown, it is necessary to examine how modern money functions. A bank deposit is not stored currency. It is a digital claim. When you deposit funds, the bank records a liability on its balance sheet. Those funds are pooled and used to extend loans, purchase securities, or support other financial operations. The deposit remains accessible because the system assumes that not everyone will demand full withdrawals simultaneously. This assumption is confidence. Confidence is the foundation. If confidence weakens, liquidity tightens. Liquidity tightening is rarely allowed to unfold openly. Instead, it is managed. Management often includes restriction. In earlier eras, restriction looked physical. Banks closed doors. Withdrawal limits were posted. Currency exchange windows shut temporarily. In modern systems, restriction is digital. An account can be flagged by automated monitoring software. A transaction can be paused pending review. A withdrawal can be limited to a daily threshold. The balance remains. Access narrows. The narrowing does not require insolvency. It requires procedural authority. Banks operate under extensive compliance frameworks. Anti-money laundering regulations, sanctions enforcement, counter-terrorism financing rules, and risk monitoring protocols are integrated into transaction systems. Every transfer passes through filters. Filters detect anomalies. An anomaly does not require guilt. It requires deviation. Deviation triggers review. Review triggers delay. Delay becomes restriction. The mechanism gap emerges here. How can systems restrict without warning in economies that appear stable? Because the warning is structural, not personal. The authority to restrict exists long before it is exercised. Terms and conditions include clauses permitting account suspension under suspicion of irregular activity or risk exposure. Most people never read these clauses. They assume normalcy will persist. Normalcy persists until it doesn't. During financial crises, broader restrictions can emerge. In 2008, interbank lending froze before retail customers noticed anything unusual. Liquidity vanished in wholesale markets. Central banks intervened to prevent cascading failure. The public experienced limited visible restriction in many countries, but the infrastructure was under strain. When strain intensifies further, retail restrictions can follow. In Cyprus, large depositors saw portions of their balances converted into equity during the banking crisis of 2013. Access to funds was limited. Capital controls were introduced to prevent rapid outflows. The banking system did not evaporate. It compressed. In Argentina's 2001 crisis, daily withdrawal limits were imposed to protect currency reserves. Depositors retained nominal balances. They could not reach them fully. Restriction preceded collapse. The system's priority was survival. Survival overrode immediacy. Modern regulatory frameworks increasingly formalize such responses. Post-crisis reforms emphasize bail-in mechanisms, where creditors and uninsured depositors absorb losses before taxpayers intervene. This shifts burden distribution. Deposits above insurance thresholds represent unsecured exposure. Most depositors focus on the number in their account. Few examine the hierarchy of claims in bank resolution frameworks. Late realization arrives when access is modified. The illusion of safety persists because restriction is rare. Rare does not mean impossible. Digitalization increases control precision. Cash once provided partial autonomy. Physical notes allowed transactions outside centralized networks. As cash usage declines and digital payments dominate, transaction visibility increases. Visibility enhances monitoring. Monitoring enhances intervention capacity. Intervention capacity remains dormant during stability. Dormancy creates trust. Trust sustains leverage. Leverage increases fragility. Fragility requires readiness. Readiness includes tools for restriction. Central banks maintain liquidity facilities to support institutions during stress. Repo operations, emergency lending windows, asset purchase programs. These tools stabilize banks. They do not guarantee uninterrupted retail access. If liquidity stress accelerates beyond containment, authorities may impose withdrawal limits to prevent runs. Runs are contagious. Contagion destabilizes balance sheets. Preemptive restriction can contain contagion. Containment restricts access. The consequence gap widens. If high-debt economies rely on continuous liquidity to sustain growth, what happens when confidence falters? Debt levels across sovereign, corporate, and household sectors have risen significantly in recent decades. High leverage increases sensitivity to shocks. Small disruptions in funding markets can ripple quickly. Ripple management may involve liquidity prioritization. Prioritization may involve limiting outflows. Limiting outflows limits access. The system does not need to confiscate deposits to manage risk. It needs only to delay usage. Delay changes behavior. Behavior affects stability. Stability preserves institutions. Institutional preservation underpins monetary continuity. Monetary continuity sustains asset valuations. Asset valuations support pension funds, insurance portfolios, and sovereign financing. The hierarchy becomes clear. Individual immediacy is subordinate to systemic continuity. Compliance holds illustrate everyday restriction. If a bank's algorithm flags unusual activity, accounts may be frozen pending investigation. The process can take days or weeks. The individual must provide documentation to restore access. Documentation restores compliance. Compliance restores permission. Permission governs liquidity. Liquidity feels like ownership, but ownership without permission is symbolic. Sanctions regimes reveal another dimension. Financial institutions are obligated to freeze assets connected to sanctioned individuals or entities. These freezes occur instantly. The broader system may remain stable. Access is removed administratively. The infrastructure enabling this is universal. It is built into global payment networks. Most assume such measures are distant. But the capability exists within domestic systems as well. In periods of geopolitical tension, scrutiny intensifies. Intensified scrutiny increases temporary restrictions. Restriction frequency rises quietly. The system remains functional. Access becomes conditional. Credit lines operate similarly. Banks can reduce limits or close revolving credit accounts based on internal risk reassessment. These actions do not remove deposits but constrain spending capacity. Constraint alters economic activity. Economic activity affects revenue. Revenue influences employment. Employment influences default probability. Default probability influences further tightening. The loop is gradual. Restriction without warning often reflects internal recalibration rather than overt crisis. Recalibration can be triggered by macroeconomic indicators, rising delinquency rates, increasing sovereign bond yields, declining collateral values. These indicators may not be visible to retail customers. Institutions act based on aggregated data. Individuals experience isolated restriction. Institutional asymmetry persists. The final closure of the mechanism gap lies in recognizing that access is a managed output of a leveraged system. Your account balance represents a claim within a structure dependent on liquidity, regulatory compliance, and solvency. If honoring all claims simultaneously threatens stability, the system prioritizes survival. Survival may involve temporary restrictions. Temporary measures can redefine expectations. Expectations shape trust. Trust underpins monetary systems. Monetary systems fail slowly. They do not collapse instantly in most cases. They adjust. Adjustment may involve subtle erosion of unconditional access. As economies digitize further and debt levels remain elevated, the capacity to restrict quickly increases. Speed matters. Digital systems allow immediate intervention. Immediate intervention can preserve stability. It can also eliminate warning. Restriction without warning feels abrupt because the underlying authority has been embedded quietly for years. The authority exists in contracts, regulations, and policy frameworks. It is rarely activated. When it is, it appears sudden. But structurally, it is continuous. Access is granted through participation in a network of obligations. That network is designed to manage risk. Risk management prioritizes the whole. The whole sometimes constrains the part. This recognition is not a prediction of inevitable lockouts. It is an acknowledgement of architecture. Money today is mediated through institutions. Institutions operate under incentives to preserve stability. Stability sometimes requires delay. Delay sometimes requires restriction. Restriction does not mean collapse. It reveals hierarchy. Hierarchy clarifies priority, and priority defines whose access is immediate and whose can wait. Restricted without warning does not imply chaos. It implies that the system is functioning according to its design. A design where access is conditional, where permission underlies liquidity, where stability outweighs immediacy, and where the authority to restrict has always existed, even when unused. Understanding that does not change the structure. It simply reveals that the absence of warning is part of the mechanism itself.